Good morning, traders. My name is Brad Matheny. This is the MENT.com investor update. This is designed to be a very quick video, hopefully, that teaches you what to expect going forward, what I'm looking for as far as market trend, sector rotation, and opportunity, and to prepare you for how you should be managing and altering or potentially addressing growth and hedging concerns in your 401k, IRA, or retirement account. Now, this is a free video that I push up on YouTube to share with everyone. It's designed to help everyone. It may not be free forever, I'll let you know. Please visit my website, MENT.com. This is what I do. I do the research. I do all of this for you every week to try to help you learn how to better protect, manage, and grow your assets and show you where the opportunity is and advise you as to what you want to be doing. Now, longer term, you should really be following my MENT rotational modeling system here. This is the meat and potatoes for investors to be able to grow your wealth efficiently. If you are not following this MENT rotational modeling system blue line and understanding what's going on with the market trends, you are likely leaving 60 to 70 cents of every dollar in profit that you make on the table. This orange line is the S&P 500. If you invested $100,000 into it in 1996, this is where you would have been as of today, about $660,000. Whereas if you had taken the same $100,000 and invested it in the SPY using my MENT rotational modeling system, you'd be at $1.72 million. Think about that for a minute. That's almost 300% more than just leaving it in the SPY. And that, again, is the benefit of actively managing your investments effectively. Okay, so this all can be done here at MENT.com. I offer a very inexpensive solution. I offer a 60-day expert growth trial, which includes the MENT rotational modeling system and more. I offer fully automated trading systems and consulting services. So remember, go to MENT.com, check it out. Here's the URL. And of course, if you like what I do and you want me to help you, it's a very inexpensive way for you to actually protect and grow and manage your wealth. Okay, so now we are going to move into let's come back over here and real quickly talk about what I believe is going to happen over the next couple of years. This is a monthly SPY chart. I've highlighted this last week. We're very, very close to this rollover peak up over here, 425 to 430, maybe 435 in the SPY. And in reality, 420, 421 in the SPY, I'm going to start to get very concerned that we have reached that limit. So the 425, 435 area is the general area that I've been talking about, but anything really above 421, 422, there's really very limited upside move left. It could still move another 4, 5, 6%, but I think that it's nearing the end of its rally here. Then we're going to see a pullback possibly down into this 400, 408 area. Which means we're going to go from 420 to 408. That's going to be maybe 404. So that's going to be, let's call it a 20-point move. And that's going to essentially be a 6 to 7% pullback. And then we're going to try to base, and then we're going to see some sort of an upward move here. This is your next real big opportunity. But as an investor, I'm telling you that loading and moving into sectors that may trend consistently here over the next 12, 18 plus months could provide you some real growth, could provide really 10, 12, 20% growth in your retirement account. And that's where we're at right now. You're almost a little too late to get into this at the moment. If you haven't made these adjustments back over here, I wouldn't worry about trying to readjust over here. But when you get into the July, August timeframe, you need to start making some adjustments to your retirement account and preparing for these potential trends that are setting up with regard to this move here. This move, I've drawn this here, I can get to it, is a 25% potential upward move in the SPY. that could be a 25 to 35% upward move in certain sectors. Maybe a little less, maybe a little more, depending on what we're seeing. But this is the next big phase of opportunity is right here. July, August, September of 2023. Okay, so let's come back over here. Take a look. Consumer continues to stay out of this trend. We've broken back down. I've drawn this orange line and this red line here. Basically, consumer is nowhere near engaging with this economy right now. And I believe that we are going to continue to see downward trending consumers simply because they are buried under a swath of undervalued assets. A lot of people I talk to, in fact, a lot of people I know in this area are buried in potential credit card debt, potential car payments. A lot of people I know went out and bought cars over the last couple of years, and they weren't these little cheapy little, $10,000, $12,000 cars. They were these $60,000, $80,000 vehicles. They're looking at, $800 to $1,400 a month car payments. And of course, their credit card debts have shot up from 7 to 9% theoretically up to 21 to 23%. So you've got consumers really feeling the brunt of the concern here. Now, obviously, if you are a high-end consumer where these things don't bother you, you're making 25, 30 grand a month, spending $1,000 a month on a car doesn't really bother you. But if you're an average consumer and or if you're a regular consumer that has been living on borrowed money for the last 6, 7 years, this is really going to start to bite into your capabilities. You are not going to be spending out at going out that often. You're not going to be traveling. You're not going to be spending foolishly. You are going to be trying to whittle down that debt knob that you have down to something that's manageable. And I believe that's what we're looking at here. I don't believe we're going to see the consumer re-engage until we get closer to 2024 presidential election. Maybe the last 6, 7 months of 2024 before the election, we might see the consumer start to move higher. But again, if we can't get above this red level here, and particularly stay below this kind of gold level here, consumers are disengaging. We are in a contraction, deflationary cycle. So we are not going to see a whole bunch of real economic growth in a consumer contraction phase. This is a custom devaluation cycle phase. Very important to understand. It might be a little hard to see down here. I'm going to make it as big as I can for you, but throughout this entire phase, now all of this is 2020, end of 2022, and beginning of 2023. The actual devaluation of hard assets is flatlining. We are not seeing any real growth. We are not seeing any real asset appreciation. We basically are seeing the core commodity index, the core asset value index, pretty much flatline down here into nothing. So now understand, this is 2018, 2019, 2020, 2021. I mean, we were at, higher levels back over here near 0.7, 0.8, maybe even up in 1 right over here. But at this point, we're down here at 0.59 and looking to go downward. So what this is telling us is that we are seeing extended contraction in the economy. We're not seeing growth. We're not seeing economic activity. We're not seeing consumers really come out and really driving prices up and down. What we are seeing is generally this market is flatlining. It is not growing, and it more than likely will enter some sort of an extended sideways contraction phase. Now I'm going to draw or zoom in here again. Imagine if we were to stay down in this lower channel. You can see this red line here and this green line here. Imagine if we stayed in this lower channel all the way through November 2024. Imagine the fact that we have struggling consumers, struggling businesses, struggling tax revenues, struggling transportation index, Struggling economy, imagine that were to hold into place. The only thing that's moving are hedge assets and specialty sectors that are driving the what I call essential consumer products, the toilet paper, toothpaste, and essentials type of business. So understand that that's where we're at possibly for the next 16 to 24 plus months. And this index is showing us there is just literally no growth taking place. Absolutely zero. This could obviously contract into a crisis mode. If we see this extended contraction for very long, you can see we normally have some sort of a broad kind of a breath here. If we stay in this contraction phase for another, say, 10, 12, 15 months, we could see some real crisis events take place. We'll see what happens. Fear index is moving downward. S&P 500 is moving upward. We want to see this fear index move down below, say, 6.5, 6.4, kind of back into this area. This was just before COVID. This indicates when we move away from fear over here, this indicates that we are going to see potentially some upward growth in the stock market. And it's going to take pricing pressure away from metals, which I believe could happen, particularly over the next 3 or 4 months. But we have gotten kind of up into this extended phase here for the custom U.S. sentiment, stock market sentiment index. I think we're nearing a peak. I think we're going to probably find a peak over the next 10, 15 days, probably around the end of April 28th, like I told you last week, and then see some sort of contraction back down until we get to July, August, September. So we could see this peak out, roll over, and move back down into June, July, August. May not be very aggressive. It may not be a big trend. It looks like we are reaching this upper peak area, a little overbought, let's say, and we could still see fear move up a little bit. To stay in this moderate fear range, we just need to stay away from this elevated fear area. So this was getting very close to, with the banking crisis, getting into extreme fear, but we're not there yet. We're moving back away from it. The valuation trend index, this is a custom U.S. stock market trending system that shows us when valuations are increasing. We saw a great valuation increase back in March. April, so far, first half of the month in April is looking really ugly. It looks like we're going to stall back out, particularly if my topping pattern appears near the end of April. I drew this line to try to highlight how we are moving into this channeling formation. We could channel and move downward, or we could channel and move through this area over the next 6-10 months. And then really you see this arcing level that carries back over here. Sorry, I can't draw the chart over. But we could be looking at, look at where this is. This is 2023. So this is really lining right back up with my end of 2024 time frame. So you've got essentially 12 months here. We're at April 2023. This would put us about April 2024, May, June, July, August, right about August. We could be looking at a fairly big move in 2024, either up or down. So we have to see how this plays out, but we are not seeing any valuation appreciation in the U.S. stock market or in the global markets yet. We're actually in a very tightening, contracting range. And lastly, the custom volatility index. I highlighted this last week for members, and I thought I'd throw it in here. The custom volatility index above 12, 12 and a half here is really worrisome for a potential top setting up. We've moved higher. We've had a higher high compared to this and compared to this. We've had a higher low compared to the capitulation bottom. We're back up here to the double top. We could easily move up here into the 13.6, 13.7 area, setting up my peak in the SPY around 420, 425, maybe a little higher, then immediately begin a contraction phase back down. And we would very likely base and bottom back down here around 9, 8.5, 9.5, back down in this area. This really is very worrisome for a top. You can see that, this was easy Fed money, speculative phase, rallying through 2021 after the COVID bottom. This was 2018. We had gotten way up here before our collapse in early 2018, then rebounded, then collapsed into December 2018, then rebounded out of it before COVID. This was the COVID low. This was the reflation trade after COVID. We could very easily move back down into a tightening, congesting phase for 2, 3, 4 months, maybe into, like I said, August, September, October 2023. So be aware. In my opinion, we are very close to a top. We have very limited upside potential in the S&P for short-term traders. The best thing that you can do is position yourself into metals, miners as a hedge, possibly a small position in bonds, and then pay attention to the sectors that appear to be moving substantially. And for that, you would need the MENT expert growth. The expert growth. I will show you real quickly. This is the core list for MENT expert growth, and these top 4 or 5 sectors: agriculture, miners, gold, S&P 500, QQQ, Invesco QQQ, silver, consumer staples, cyber security, technology, healthcare, and Dow Jones are looking moderately strong as sectors that are going to perform. So remember, if you are an investor or a trader and you really want to get the best advice that I can offer you, come to my website, MENT.com, join Expert Growth, get it for the special deal, $34.99 for a 60-day trial, and let me show you what I can do to help you better manage and grow your wealth over time. Not only that, you're going to get instant access to the MENT rotational modeling system so that you'll be able to start managing your investments more effectively. Okay, guys, that's it for now. Talk to you soon.